What is happening, guys and gals? Joe Badger here, your money mentor, where we have deep pockets and short arms, and where I help you with my nearly 40 years of experience with investing, business, entrepreneurship, and personal finance. So this is Women and Investing Part 2. So much to go over, so much information to digest that I had to do 2 videos on this. Now in this video, what I want to go into are some details on a few things. One is actual investing products like mutual funds versus stocks. I want to go over some different resources that I want to recommend for you women out there. I want to talk about other concepts like investing yourself versus hiring a financial broker. So there are a lot more things to really talk about and go into, but before we do that, make sure you subscribe to the channel because we have a lot more coming and you do not want to miss out, and make sure you like the video. So let's get started. Let's go into part 2, Women and Investing. In the first video, we established that there are more women who are interested in investing into the stock market than ever before. So I think it's important that we lay a really good foundation to get you started on your investment journey. And we're going to end this video with the #1 investing tool to get you started. A mindset that I think a lot of investors and wealth builders need to know, that the wealthy are always doing 4 things. They are always earning, saving, investing, and then spending wisely. Now, let's talk about earning. Our income is very important, but if we don't save any money, then we don't have anything to pay the bills with, and we don't have anything to put into investments. Number 3 is investments themselves. When you have savings and they just sit there, then they actually go down in value because of inflation. So we need to be investing that money and gaining interest, earning interest over time, building a nest egg, building a retirement fund, slowly growing that. In other words, making that money work for us. And that is an important concept. Lastly, we all need to spend money, whether it's on bills or on the mortgage or on living expenses or on entertainment, whatever it is, we need to spend money. So when we spend, we have to make sure we're doing it thoughtfully and wisely, that we're not just doing it impulsively. Spending is something that we all do, but we have to take into account how are we spending, on what, and can we refrain from spending? If we can, the better we can hold off from spending money for something we don't need, the better. So those are some good, really underlying concepts to remember, that the wealthy are always earning, saving, investing, and spending wisely when they are spending. If you're going to be in the stock market, then you're going to have to know about the fundamental driving forces. And in many cases, those fundamental driving forces, believe it or not, are fear and greed. And this is what keeps a lot of people out of the stock market. What happens is when the market is going down, and it's been going down for a while, people get very fearful and they sell off and they lose a lot of their money. On the other hand, when the market is going up, and it's been going up for a long time, for months, and we're hitting all-time highs, that's when people buy in at the wrong time, and they think it's going to keep going up, and then it ends up turning and coming down. So once again, they made another terrible mistake. What you want to be doing is the exact opposite. When the market is going down for a long time, for weeks, for months, even for years, unfortunately, and everybody is fearful, and as Warren Buffett likes to say, there is blood in the streets, that's when you should be buying. And on the other end, when the market is hitting all-time highs and it keeps going up, it's been going up for months, And for years, that's when you should be selling. When you are watching your investments and you see that they've been growing over time and you made some really good gains, you want to preserve your capital, sell off, and take in those profits, and then re-examine your portfolio again. Unfortunately, because we are emotional beings, we all can fall for this. We can all get fearful, and we can all get greedy and think that the stocks are going to go to the moon, that the stock market is going to keep going up forever, but it doesn't. Over time, it naturally grows, but there are peaks and valleys. And the important thing is to just keep your emotions in check. Know that you have to have a certain mindset the whole time. In fact, I made an entire video on the mindset of investing, and this is very worth checking out. But keep in mind that we're going to get fearful and we're going to get greedy, and being self-aware of that. And by the way, if you can keep your emotions out of your investing, the more the better. That is great. It's very difficult because when the market's tanking and we're all fearful, it's tough to watch our accounts just go into the red and keep going down. So the best thing is to be aware, be self-aware that these are true, very real driving forces, fear and greed. And as long as we know that, we are a mile ahead of the game to begin with. The next concept that I want to talk about, I call the O'Leary principle, named after Kevin O'Leary from Shark Tank. Now, whether you like him or hate him, he has some really interesting things to say about women and investing and entrepreneurship. As it turns out, most of the businesses that he has invested in when he's on Shark Tank have been run by women entrepreneurs. And when he examines his entire business portfolios of men-run companies versus women-run companies, you find that the women are doing much better. And so we had to naturally find out, why is this? When he dug into it a lot deeper, he found out that the women are much more realistic about their goal setting and achieving and hitting those goals. It turns out the men were setting higher goals, much more unrealistic goals, and not hitting them every quarter, whereas the women were setting goals, high goals, but they were much more realistic and they were much more obtainable. So when they hit those goals, it was positive reinforcement and it was good for their business. When the men missed the goals most of the time, what happened was that it was kind of a negative force. There was some strife and they were upset because they weren't hitting their goals. So it's really interesting, this insight that he has come about. It's a very unique thing, and it's some real data about women entrepreneurs that have a very realistic goal when it comes to business. And I think that also applies to investing. Making sure that you have a very realistic attitude about what you're investing in and what kind of gains it's going to have for you, and the different time frames involved as well. The other interesting thing about Kevin O'Leary, like I said, whether you love him or hate him, I read one of his books, and he talks about his mom and how his mom had such a great influence on him throughout his whole life when it came to finances and business. And he just adores his mother, and he's always talking about her. And it's very refreshing to hear and to see, because maybe when you watch Shark Tank, you might not get that impression of him, that he's always cold-hearted and always talking about numbers. But it's a very endearing thing to hear him talk about his mother and how close he was to her and how much of an influence that she had on his investing life, personal life, business life, etc. So it's worth keeping in mind this O'Leary principle that women are much more realistic when it comes to business and investing, and keep that in mind in your own investing in the future as well. Let's talk about the difference between stocks, mutual funds, index funds, and ETFs. These are all really great investment products that you want to consider as you are going to invest your money into the stock market. Now, I have an entirely separate video on this, and it's worth checking out. However, the basics of the video is this. One individual stock represents just one company, whereas a mutual fund is a whole collection of companies. And the idea is that there are safety in numbers. It's going to rise and fall a lot slower, and it's managed. And it's going to be a lot less volatile than one company stock. An index fund is something that is a mutual fund which follows a certain index. For example, the S&P 500 is an index of 500 stocks within the stock market, and there are millions of stocks. But these have been chosen because they're stable companies, and it's a bellwether. It tells us where the market in general is going on a daily basis, up and down. Those 500 stocks are representational of the entire stock market. And that index fund follows the ups and downs and the path of the index. So the idea there is to save a lot of money on fees and expenses because it's not a managed fund. It's basically just following the index. And then lastly is an ETF. An ETF is a relatively newer product like a mutual fund, but it's something that you can follow in real time. You can watch it go up and down as the market goes up and down daily, instead of waiting till after the close of the bell, which is what you have to do with a mutual fund. But an ETF is also a collection of companies, maybe as many as 100, and they usually represent a certain sector or an industry. And that comes to diversification too. When you're investing with a stock or a mutual fund or an index fund or an ETF or any other financial product out there, you want to make sure that you are diversified. And this is basically a safety net for you, because if you have all your eggs in one basket, if that one company goes down, or if that one industry goes down, or that one sector goes down, then you're safe with the diversification that you have in many other different areas. So those are some really good concepts to keep in mind, and it's important to know the difference between one stock or a mutual fund, which is a whole collection of different companies, the index fund, and the ETFs. As you get into the stock market, there are some other things you need to consider. One, are you a short-term, medium-term, or long-term investor? Also, do you want to work with a professional stockbroker, or do you want to manage the money yourself? Those are two big, huge considerations to think about over time. So the difference between a short-term, medium-term, and long-term investor is this. If you want to be in and out of the market and you want to make some quick money, which is usually under the time frame of a year, that is short-term. You could make money in 1 day, 1 week, 1 month, less than a year, and there's very little commitment, but there usually is a lot more risk in that. Medium term, I would say, refers to anywhere between 3 to 5 years. That means you're holding stocks, you're investing, and you're expecting some growth out of them, but you may have some other ideas of things to do with your money in the future, such as put it in real estate or buy a home or something else. That's medium term. And then long term is more so something that you are building a nest egg for retirement. And that's 10 years or more, 10, 20 years or more, to watch that grow, watch those investments grow over time, develop that compound interest that we talked about, and just grow into something, a nice, beautiful chunk of money for your own savings, for your own wealth building, for your own retirement fund. Now, do you want to hire a professional stockbroker, or do you want to manage your own money? Are you that competent? Are you that confident that you can manage your own money? Can you handle those day-to-day risks? This is, once again, another mindset thing that you have to think about. Is this something that you would enjoy doing on your own and can handle? I think a lot more people can do this than they think. In fact, when I think of professional stockbrokers, so to speak, I think of salesmen. They're always trying to sell you something. They're always trying to take all of your money, invest it somewhere, because that's how they make money. If you ever watched the famous movie, The Wolf of Wall Street, the scene where Matthew McConaughey is talking to Leonardo DiCaprio, and it's almost a terrible scene in one way, because he says, listen, no matter if the stock market goes down or if it goes up, we make our money. And that's what it is. And so that's why you have to be very careful when going with a professional stockbroker. A lot of people do. Even I have family members and friends who do, of course, and maybe they do very well. But my philosophy is that almost anyone can do this on their own if they have the right information. So that's something you have to decide for yourself. Are you willing to take that risk? Do you have that mindset to invest for yourself? Or are you going to hire a so-called professional to do it for you? A great concept to keep in mind when you are investing is to determine whether the stock you are about to buy or the financial product you are about to buy is 1, a gamble, 2, a trade, or 3, an investment. Now, there are a lot of different types of investors when it comes to the stock market. There are gamblers and speculators. Those are people who really aren't putting much research into the stocks and into the buys, and they're just kind of jumping in. There are traders and day traders. And the information out there on day traders is that 90% of them are unsuccessful. It's very difficult to do. And then there are investors. And if you know anything about the stock market or investing history, you would know the name Warren Buffett, who is arguably the greatest of all time when it comes to investing. He doesn't just invest in individual stocks and buy and sell. He invests in entire companies and holds on to them for life. Warren Buffett is an investor. He's not a day trader. He's certainly not a gambler. And at one point in time, Buffett used to be the richest man in the world. In fact, many different times he was the richest man in the world, but these days that title has gone to guys like Jeff Bezos, the tech giants. But Warren Buffett, without a doubt, is the greatest investor of all time, and he is an investor. So keep this in mind on each stock or each purchase that you're making. Is this a gamble? Is it something that I can make some quick money with? And am I taking a huge risk while doing that? Or is it a trade? Is it something that maybe it's not even a good company, but it's worth buying because you've been following a pattern and you think it's going to go up, and you're not going to hold on to it for a long time, and you're going to get rid of it, and hopefully you're going to make some money on it? Or is it an investment that you want to hold on for a long period of time because you know it's going to make you rich slowly, and it's going to grow over time, and it's something you can hold on to, you're going to reap dividends from it? So it's important to distinguish these 3 things with each of your trades and each of your investments. So here we are. If you made it this far, we are going to talk about what I think is the number 1 investing tool at your disposal right now, and that is your income. I know it's not a fancy investment product to invest in the stock market, but if you have a good income, it's coming in regularly, and you can count on it, and you could take that income and create savings and then investments for it. So your income, never forget, is your number 1 investment and wealth building tool. Now, I would be remiss if after making these videos about women investing, I didn't leave you with some very valuable resources. So those come in the form of 3 books that I would highly recommend. The first one is called One Up on Wall Street by Peter Lynch. This is a book that I read many years ago when I wanted to start really researching information about the stock market and understanding just the fundamentals and how it really works. It's written by a guy who used to run a famous fund for Fidelity that averaged over 30% every year. It was outstanding. Probably one of the best fund managers of all time. Number 2 is a book called The Woman Millionaire Next Door. Now this may ring familiar because there's a famous book out there called The Millionaire Next Door by Thomas Stanley. And I read that book, and when my daughter got a little older, Stanley came out with another book, a follow-up, The Woman Millionaire Next Door, and he talks about the details of and the profiles of the wealthy women in America and how they got there and their daily habits and so on. And that includes investing as well. So I would highly recommend that book. And then the third one is, yes, we come back to Kevin O'Leary from Shark Tank, whether you love him or hate him. One of the books that I read from him is very interesting. It's called The Cold Hard Truth About Men, Women, and Money. And he talks about himself growing up, his investments. He talks about his relationship with his wife and his mother. And he talks about how might be the best way to, I was going to say invest in a wedding, but that's really not how he would say it, but to structure a wedding so you don't go broke. So those are some 3 really good resources that I think I can leave you with here, and that would help you really understand investing in the stock market in an overall and in a general sense. So there you have it. I know it's a lot to digest, but I hope I at least helped you some way in your journey with the stock market and investing. If you like this video, make sure you subscribe to the channel because we have a lot more coming and you do not want to miss out. And also hit the like button to help the video as well. Otherwise, I wish you good luck on your investing journey, and let me know in the comments if you have any questions, because I'll try to do my best to answer them as well. But I hope you do very well, and I hope that the stock market treats you good.